Wall Street Unplugged looks beyond the regular headlines heard on mainstream financial media to bring you unscripted interviews and breaking commentary direct from Wall Street right to you on Main Street.
What's going out there? It's May 3rd. I'm Frank Curzio. It's the Wall Street Unplugged podcast where we break the headlines and tell you what's really moving these markets. Just a heads up. Expect a few rants today. May go off the rails a little bit. But today is Fed Day. I'm taping this just ahead of the Fed meeting. The Fed expected to raise by 25 basis points and then pause, right? That's the consensus. 100%. 100%. That's the chances that it's going to be 25. You'll know by the time you listen to this. Then we'll have tomorrow. Tomorrow is always a fun day where every economist in America pretends that they're the Fed commissioner and brags that they know more than Jay Powell. Breaks it down. No matter what they agree or don't agree, nobody likes the guy, right? They're either going to criticize the Fed for raising, say Powell's insane. We're in the middle of a banking crisis. We're seeing the cracks in the foundation and commercial real estate. They need to pause right now. And others are going to say unemployment is still low. Wages are strong. Inflation is still way above the Fed's 2% target. So they have to keep raising. They're going to lose credibility. That's what we're going to hear back and forth, okay? Well, let's strip out the bullshit here. Because 25 basis point hike or no hike, it doesn't matter. It really doesn't. It could make for news, commentary. It could matter over the next couple of days or whatever. But look at the big picture. The Fed could always lower rates if the economy crashes. Inflation picks up, which is considered a positive economic indicator, right? So inflation is picking up. It means more and more people are paying higher prices for goods, right? So that's, again, it's a positive economic indicator. It could always slowly raise in future meetings throughout the year, right? Which that's what they said they were going to do going forward. But when we look at the bigger picture here, rates went from basically zero, right? 0.025. So near zero to 5% in 12 months. That's a 1,900% increase in a year. Right? We talk from March to March, and I even talk about hike for today. That's the quickest rate hiking cycle in the history of the Fed. So, guys, the damage has already been done, and we're going to see it. Right? So this move, and it's going to be all over the news, and 25 basis, they should stop. Look what's happening back and forth. The damage has already been done. And the biggest story, which you should be focusing on, is the banks. Now, I want you to pay close attention to this, especially what the CEOs of these banks said just before the FDIC seized them. You ready? Because here we go. Silicon Valley Bank, February 24th. KPMG signs an audit report giving SVB Financial, that's Silicon Valley Bank's parent company, a clean bill of health for 2022. It's February 24th. Stock's trading at $315 a share. Then all of a sudden you see in the coming weeks, right? The run starts taking place. Clients start pulling the deposits. And then on March 9th, about 2 weeks later, the stock is trading at 106, right? It's trading 315, it's trading 106, right? And then President and CEO Greg Becker on March 9th says, I'm quoting, we're experiencing at navigating market cycles and are well-positioned to serve our clients through market volatility with a high-quality, liquid balance sheet and strong capital ratios. Our flexible balance sheet and long experience navigating market cycles have enabled us to effectively support our clients over time and establish a long-standing reputation as a trusted partner in both good and challenging times. That was on March 9th. On March 10th, the FDIC shuts down Silicon Valley Bank. The next day, quick note there, too. So Greg Becker, CEO, sold $3.6 million worth of shares on February 27th. February 27th, a couple days after KPMG gave him the clean bill of health. Again, they're going to say it's through his trust and he had no idea. I love it. Like, you can't call it trust and say, hey, he's just, it's kind of funny when you hear that. The trust is that's like the key, the get out of jail free card, but $3.6 million just before all this shit happened, right? Shareholders weren't as lucky. Let's go to Signature Bank, February 16th, CEO Joseph Powell says Signature was going to exit about $8 to $10 billion worth of deposits in the crypto space, which we can easily cover through cash and borrowings. That was February 16th. On March 9th, Eric Howell, the president, chief operating officer of Signature, says, as shown by our current metrics, we intentionally maintain a high level of capital, strong liquidity profile, and solid earnings, which continue to differentiate us from our competitors, especially during challenging times. That was March 9th. March 12th, the FDIC shuts down Signature Bank. First Republic. Stock starts getting nailed last week of February, the first week of March. Sharks are in the water, seeing that most of the assets are not insured. That's the playbook that we just saw for the other banks that failed. Then on March 12th, Mike Ruffler, CEO, President, First Republic, says First Republic's capital and liquidity positions are very strong. Sound familiar? And its capital remains well above the regulatory threshold for well-capitalized banks. Still quoting here. As we have done since 1985, we operate with an emphasis on safety. Can't make this shit up. On safety and stability at all times while maintaining a well-diversified deposit base. First Republic continues to fund loans, process transactions, and fully serve the needs of clients by delivering exceptional service. I'm quoting. I'm not making that up. This is a quote. On March 16th, then what happens? They get a $30 billion bailout from the large banks. So then you have Jim Herbert come on. He's the founder and executive chairman, along with Mike Ruffler, again, the CEO. This is president of First Republic, two biggest guys there. And they say, and I'm quoting, we'd like to share our deep appreciation for who? For Bank of America, Citigroup, JPMorgan Chase, Wells Fargo, Goldman Sachs, Morgan Stanley, Bank of New York, PNC Bank, State Street, Truist, and U.S. Bank. That's who funded this. Their collective support strengthens our liquidity position. Strengthens our liquidity position. Okay, this is March 16th. It reflects the ongoing quality of our business and is a vote of confidence to First Republic and the entire U.S. banking system. Now, I've been around for a while, and I have to tell you, all the banks do not do deals like this unless they're forced. Not all of them together. You'll see, underwriters and Goldman Sachs and maybe Citigroup or JPMorgan, 2 or 3. When you have the largest banks, 7 or 8, at the same time providing capital for this company, it means that they were told to do this by the FDIC, which is obvious, right? Which is pretty obvious because these guys would not do this alone. And they won't do it alone. I mean, even Goldman said they were looking at all these companies to raise money for them, and they all said, no way. As the shit hit the fan. You could see. Wall Street Journal does a great job. A couple other companies do a great job of the whole time frame, going back and forth, saying, hey, we could buy this stock, or we could buy Silicon Valley at 150 or 200, and they were like, eventually they're like, well, maybe we could buy it at $1. Why even buy it now? So they couldn't raise money. So all these guys got together because the FDIC. Now remember, this is when they raised $30 billion. This is on March 16th. On May 1st, the FDIC shuts down First Republic Bank. So now what happens? The same freaking day, I'm going to try not to curse you, the same freaking day on May 1st, right? So we're talking Monday afternoon. Monday afternoon. The king of the world in the banking sector, Jamie Dimon, says, again, this is right after the FDIC hands First Republic, JPMorgan, and silver platter. Jamie Dimon says the banking system, I'm quoting here, says, system is very, very sound. Does this sound familiar? Didn't we just hear this? It's from every single CEO of the banks that failed that just got seized, right before they got seized by FDIC. I'm not saying JP Morgan's in the same boat. We all know they have the greatest balance sheet. They're huge. They're fine. But do you believe Jamie Dimon saying the entire industry is sound now? Because the very next day, you can't make this shit up. The very next day, which is Tuesday, this is yesterday. Regional banks, Pacific West, Pac West, down 28%. Western Alliance down 15%. Bank of Ozark got crushed. The Spider Regional Bank ETF, the symbol's KRE, was down 5% in a day. A 52-week low. On relatively no news. It's not like something came out, the difference, right? It should have been okay. Bailed out another bank. The king of the world comes out whenever he comes out and says something. It's all over the news. It's great. He has direct ties to the Fed, to the biggest bank in the world. Does the right thing for people. Comes out and says everything's... The very next day, what happens? These community banks crash. Rebounding slightly today. Again, I'm doing this before the Fed. We'll see what happens after the Fed meeting. But when I see Jamie Dimon come out like this and say, like, everything's fine. We're cool. Right? Again, we heard this from other CEOs. It reminds me of Frank Drebin when he chased that guy in the Naked Gun. And the guy rode that missile into the firework factory, and the place blows up and shooting fireworks everywhere. He takes out his badge, the fireworks going off like crazy, right? The whole building's blowing up fireworks. He's like, there's nothing to see here. Don't worry, everyone. He's flashing his badge. There's nothing to see here. Favorite movie of all time. And that reminds me of Jamie Dimon right now. And Jamie, by the way, I'm being dead serious here. You should hope and pray the banking system is not sound. That's not something you should be coming out and saying. I know you have to come out and say it. I know maybe you were forced to say it, and I get it. But you should hope and pray that it's not sound. Because you're going to continue to get deals like you got with acquiring First Republic's assets. Now, I know some of you may have seen the details of this deal in the papers or the online sites or wherever you cover. But here's a few parts you might have missed. This is from someone whose job is to look under the hood for you, who's a research analyst. I'm going to share a couple of things about this deal. So JPMorgan, First Republic, is going to pay $10.2 billion to FDIC to acquire $173 billion in FRC loans. That's a loan mark of $22.5 billion. The FDIC is also going to provide $50 billion of 5-year fixed rate financing, which includes a loan loss or a loss share agreement where the FDIC is going to cover 80% of the losses for single family and commercial mortgages. Pretty good freaking deal. It gets better though, because JPMorgan, they didn't assume any of FRC's corporate debt or preferred stock, reducing the risk. Now, a little deep here, but if you're looking at the new accounting rules, which are current expected credit losses, called CECL, and how they manage them with banks. So JPMorgan is going to get a free boost to its loan loss reserves. So what does that mean? Less funds are needed to cover those losses, resulting in higher earnings. That's a big deal with banks, because as delinquencies go up, they have to take money directly from the bottom line and put them in their loan loss reserves. And this hurts earnings directly. And a lot of times analysts miss that, because that can result in a 5% miss, a 10% miss in earnings, just because they have to cover a certain ratio. And as delinquencies go up, and they're going up, they were going up from 1%, in some places at 3%, 4%, 5%, especially for credit card companies. So that number goes up significantly in the money that is needed to cover. JPMorgan gets a pass because of this. JPMorgan, when all said and done, expects to generate $500 million in net income annually from these assets. Okay, and they're going to justify this by saying, hey, it only amounts to 1% of total income. This is handed to them as a gift by the government. $500 million in net income. And I got to tell you, because if you look at the details of this and you have trouble understanding, here's a simple version. JPMorgan just handed $173 billion in loans with almost no risk. It's going to generate $500 million annually for free from the deal. But what JPMorgan won't mention is this number is going to be probably 3 to 5 times more in a few years, because JPMorgan is gaining free access to a massive group of new high net worth clients. These are huge clients that they're going to do even more business with them, more loans or whatever. Amazing for a government that promised us in 2008, 2009, when all these executives and these assholes do this time and time again, that they're going to be punished. That's it. It's not going to happen again. We're going to make sure these banks are not too big to fail. Well, they're bigger now than they've ever been, guys. I mean, how do you trust the system when you see shit like this happening? How do you trust it? You can't. Because when you look at the data, the top 15 banks now control 75% of deposits in the U.S. The top 4 control close to 50%. That's JPMorgan leading the way. We're close to 17%. Bank of America is 15%. And then there's about 15, 16% split between Wells Fargo and Citi. Close to 50%. Yet, when you look at the industry, we have over 4,100 banks in the U.S. that the FDIC provides insurance for. And out of those, 600 are publicly traded. Now, my question to you as an investor and someone who does this for a living, if you take the top 25 out of that 600, that includes those top 15, but if you take the top 25 that are publicly traded, so say, even take the top 15, say 550 banks, why would you own, as an investor or buy the stocks of any of these regional commercial banks right now? Any of them. And that's what the Fed is missing. Why would you even bother? There's no reason to buy these things. Why would you buy these banks in the first place? There's two reasons. For income or for growth. Or maybe both. Well, let's go to the income side. Because Apple's new savings bank provides a 4.5% interest, risk-free. More than almost all of these banks. So that eliminates the income catalyst. Which, by the way, they should blame themselves. A lot of these banks. Because you know as well as I do, when you have your savings account, you see the Fed raising rates like freaking crazy. Why in the hell are these banks not keeping up with the Fed? How come you're not providing me higher interest? Why? Because they're greedy. And they're making a shitload of money off of you. So if you can't earn that income, try to earn that income and take on all this risk when you could earn it for free by just going to Apple? Or even buying a 1-year treasury, which is what? 4.5%? 2 years just under 4%? Then let's look at the growth catalyst when it comes to these banks. How they grow, they get more deposits. How do you see any of these banks increasing deposits anytime soon? I just mentioned interest rates, and it's like they have exceptional interest rates, right? If you look at Apple's product, they're going to see a massive increase in deposits, right? Because all this money is going to come in. Apple can choose what they want with that money or whatever. They have a great balance sheet to cover it, whatever. That's their new product. But they're not going to see assets come in, especially with their rates so low. But also, there's zero upside in keeping your money at these banks. There's zero upside. There's no upside. The only upside is like, I don't feel like moving it. But yet you have tons of downside, especially if the Fed grows a set of balls and says, hey, if we seizure a bank, we're only going to cover the deposits that were insured, which is supposed to do, or clients with $250,000 or less in their accounts. So many of these clients could end up losing money. That didn't happen yet. They bailed out everyone. They said all the assets, even the uninsured, you're fine. And by the way, this isn't a bailout. This is coming from the banks who fund the FDIC. Well, now that that's gone, the banks have to refund, right? They got to fund the FDIC again, which is more money out of their pockets. And what do you think they're going to do to their customers? They're going to raise fees. The 4 largest banks generated over $100 billion in sales last quarter. They just reported last quarter. Nobody says shit about the banks. Everybody says shit about the oil companies. Oil companies generate more money. The hell with those guys. We got to take their profits away. They're idiots. They're dirty. They're filthy animals. They're horrible. I don't care if they provide heat for your house so you can live. The hell with them. Nobody goes after the banks, though. At least they're providing something of value. The banks, this is fees they're charging you for keeping your money at the banks for most of these guys. Investment fees for being a middleman. All right, some of them, okay, fine. They're going to get the job done. They're good. They're consulting services and able to structure deals and stuff like that and able to sell these deals. But at the end of the day, they're middlemen. They're bringing people together and making a fortune off of you and your money. Nobody talks about that at all. Politicians won't. They're crazy. But if the FDIC, seriously, if they say, hey, you know what? Are they going to keep doing it this way? Are they going to keep bailing out firms that were irresponsible in their management? That were this aggressive? I mean, it happens time and time again. Oh, it keeps happening. It's going to keep happening. But when do we put our foot down and say enough's enough? And think about it. The fact that FDIC bailed out these uninsured assets. How crazy is that? So, Frank, why is that crazy? If you look at the details, if you look at what the precedent that sets, it tells every regional bank that, you know what? Go balls to the walls. Listen, take on as much risk as you want. And if you're right, which so many of these banks were right from 2004, 5, 6, 7, and made an absolute fortune before the shit hit the fan because they leveraged 31 plus and got crushed. But take on more risk. If you're right, you make a fortune. But if you're wrong, don't worry. The Fed's going to come and bail you out. Plus, you don't have to worry about going to jail. You know, no one's going to go to jail. No one ever goes to jail for this stuff. Absolutely not. People's fortunes, their life savings are gone. It doesn't matter. You know, they put all their money into the stock. It doesn't matter. They're going to go to jail. The only people who are getting effed, I'm trying not to curse in this podcast, are you, the shareholders. Which, let's face it, and shit's not a curse word, but I'm going to use shit. Because banks really don't give a shit about you. And I hope you know that. They're going to say they do. Of course they're going to say they do. You buy their stock, become long-term investors. What happens when you go bankrupt, like First Republic, Silicon Valley, you really think these millionaires sitting on the board, they give a shit about the shareholders? They're like, oh man, I feel so bad about the shareholders right now. Oh, they just got wiped out. Stocks go to zero. You really think that's what they're saying? Because I know that's not what they're saying. What they're looking to see, especially the top executives, that golden parachutes are still viable. Since, yes, they lost their job, and that's what golden parachutes are created for. But yes, the reason why they lost their job is because they blew the company up. They took on too much risk. That's why the company was seized in the first place. That's what they're concerned about. Believe me, I've been doing this for 30 years, 3 decades. I know lots of executives. This is their mindset. They don't care about the shareholders. They're like, holy shit, how am I going to get paid? Am I going to get paid? That's all they care about. A lot to digest there. Now, tomorrow's Wall Street Unplugged Premium, okay, that podcast, Dan and myself, is going to be a doozy. Because Dan and I are going to be covering a lot of stuff and getting really deep in the weeds. And by the end of it, you're going to need to ask yourself, very important, okay, you're going to need to ask yourself this. With all these banks and many big banks, not the top 15, but very, very big banks, large bank failures, with all these failing left and right over the past month. With commercial real estate starting to crash with Blackstone, KKR, Starwood, I don't know if you're familiar with those private equity firms, they're massive. 100 billion plus. Private equity behemoths are blocking investors from taking money out of their private real estate trusts. With credit card debt hitting almost 1 trillion all-time highs and delinquency surging, and most of these companies, I don't know if you saw Capital One's numbers, Amex numbers, and it's at a 13-year high when it comes to delinquencies across the board, to where even if you look at Harley Davidson, which I mentioned last podcast, delinquency rates are higher than back during the credit crisis, to where they can't get enough people to repossess the motorcycles from people not paying. You got to ask yourself, with inflation still very much in the marketplace at over 4%, double the Fed's target, and the Fed continues to bail out banks, which is going to cause even more and more money into the system, with home prices declining, with the Fed just raising its rates at the fastest pace in the history of its organization, where they still continue to raise, and rates right now are sitting at 23-year highs. We haven't seen this since 2000. With M2 money supply falling to a 50-year low. 50-year low. Liquidity coming out of the system. With the interest payments on our debt, just the interest payment, this is due to higher interest rates, about to surpass what we pay for Social Security, defense, Medicare. That's how much the interest on our $32 trillion, the interest right now, just the interest payments. And we're going to be staying at these high interest rates for a while. With earnings falling 9% year over year, and projected to fall the next 2 quarters as well when you're looking year over year. So 2 straight quarters of net declines earnings is an earnings recession. We're going to have at least 3, maybe 4 quarters of earnings declining. You look at AMD. AMD, oh, it fell a little bit. They just reported sales are down. Sales down 10% year over year. You look at NVIDIA, their last quarter everyone's happy about. NVIDIA's sales fell 20%. Their earnings fell 50%. Earnings are falling. Sales are falling. They're beating estimates. Those estimates are being revised lower, but they're falling. So earnings are crashing. The stock market trading near its all-time high in terms of valuation when factoring interest rates and earnings growth. With the possibility of the U.S. defaulting on its debt, as Janet Yellen came out yesterday, saying the government's going to run out of money. Think about this. The government's going to run out of money in less than a month, as tax receipts are much lower than expected. Why are they lower than expected? That's a sign the economy is not doing well. And yes, also a sign that 2022 wasn't a good year. You don't have lots of capital gains. But if you look at this date, it's very important. I was tweeting about this at Frank Curzio. This date was marked from Goldman Sachs, the debt ceiling, because I was like, when is it? When is it? Daniel, I was trying to, when is it? So I started doing some research on it. They had it in September and August. That's when we're running out of money. They didn't know when, but September to August. So we had some time for our wonderful politicians to get a deal done. Now it's less than a month away, of which the House and the Senate are not even going to be in their offices or convening in their offices for like 20 of these 30 days this month. So will they get a deal done? I don't know. I mean, based on how much our politicians hate each other, I don't think they're going to get a deal done in time. I think they're going to test each other. But that's going into the next 30 days. You also have to ask yourself, with the yield curve still inverted, which has preceded every single recession with 100% accuracy since 1955. So if you ask yourself all those questions, should the S&P 500 be trading up 7% year to date? Should it be flat over the past 12 months in the face of rates going basically from 0 to 5%? Should 60% of S&P 500 companies be trading above their 200-day moving averages? Should 70% be trading above their 50-day moving averages? Should home builders be trading near all-time highs? Those are the questions you need to ask yourself. Because it's coming. The data's there, the writing's on the wall. It's just a matter of time. You may be able to push us out here and there and battle out here and there. But now the next leg drop's probably going to be commercial real estate. You're seeing delinquency rates starting to surge. You're still seeing parts of the economy do okay. So, and you're looking at the hotels and everything do well. We just saw positive job numbers with ADP. Manufacturing numbers came in a little bit ahead than expected. So the Fed, man, I told you they're effed a long time ago because they still have inflationary indicators, and inflationary indicators may not be around. I mean, there's lots of them, and I can give you 10 that tell you that we're going to recession, but I can give you 10, and the 10 I'm going to tell you that we still have lots of inflation are the ones that affect us the most. People. Your food prices aren't coming down. The hotel prices aren't coming down. Your travel expenses aren't coming down. Your gasoline prices are not coming down. They're going up even though oil's coming down. Electricity prices. I mean, you're looking across the board at every bill that you pay. You're not seeing a decrease in that. Nobody is. You're not. You can't tell me, oh, well, inflation's coming down based on these indicators. Certain indicators, yes. But if you're looking on a personal level, they're not. Leaves the Fed in a tough spot where I don't know what they're going to do. Probably raise 25 basis points. I'll take the consensus and say, okay, we may pause. They're not going to say we're pausing. They have to say we may pause because if inflation really starts to surge and it goes to 5%, 6% again, they're going to have no choice. And they don't want to paint themselves in a corner. They did that several times. It's transitory, it's transitory, it's transitory. Holy shit, it's not transitory. We've got to raise rates at the fastest pace ever in our history, right? You look really, really bad when that happens. These are the questions you need to ask yourself. I'm not saying to sell everything. There's pockets that are doing well, but there's also pockets that are not doing well. And you need to protect yourself. Provide some protection. We do that through put buying, where you covered 3%, 5% of your portfolio, whatever. We've done that in several portfolios. And admittedly, the last few months, the market's been doing good, and those things don't do that well. So what? You lose 5% of your portfolio, but the rest of your portfolio should be up a lot, and we're doing pretty good with our portfolios because the market's up. But when the market comes down and pulls back, and it will due to these, there's just too many negatives. We're not even talking about Russia. We're not even talking about the recent news that came in today with Russia where you know, an attack on Putin, which I guess should be expected, right, with drones, but I can guarantee you those drones are from AVAV, which is an American company. They try to kill Putin. And we're not even talking about those types of risks. We're not even talking about, you know, all the BRIC nations and everybody dying to join the BRIC nations. Have you seen that? And just and creating the digital currency and moving away from the U.S. There's so many risks out there. Trust me, you know, I'd love to be, you know, use the term again, balls to the wall and be aggressive. There's times to be aggressive. There's other times you have to protect yourself. Protect yourself. It'll be worth it. Okay, you need some kind of insurance on your portfolio, but this type of insurance when it comes to put buying, and we do this with Money Flow Trader. You can go to mftoffer.com if you're interested. Can we lower the price for that? Or learn how to do this. Again, you're only going to lose as much as you put into these trades. So you're not shorting where you can get wrecked. The market just goes in the wrong direction and skyrockets from here, which could happen over a month period before it crashes. I don't know. It's hard to predict. But don't go all in on this, but protect some of your portfolio because it's not just insurance where if the market does crash, that 5% that's in that or 3% could be worth more than 50% of your entire portfolio. And we've seen massive, massive winners during COVID. We've seen massive winners when the market crashed last year. And again, just be prepared that if the market continues to chug along and do well, these are long-dated puts, that you may lose your money in that position. But you need to protect yourself because once you lose the money, it's gone. You don't get it back. Okay? And what you want to do is when the shit hits the fan and shit crashes, that's when you want to be greedy and aggressive. And that's going to happen. There's times to be greedy and aggressive. Did it in May, right? The market crash, buying great stocks, some of the best of breed stocks, generating huge returns, right? There's times to be greedy right now. You have to be a little fearful. You have to protect yourself. There's a lot going on. Dan and I are going to cover this much, much more detail in Wall Street Premium tomorrow. And that's our premium podcast. Also gives you free access to a dollar stock club portfolio, which includes one trading idea every week where we write up and give you buy up to price, stuff like that. We also share research tools. So we're sharing our tools with you so you educate yourself. See how we come to these conclusions, right? We're not analysts that just say, hey, this stock's going to $100. There's numbers. There's research that goes behind this, right? Which, the boring part that we don't share. But when we recommend stocks and when we do research on stuff, there's a big process to it, okay? A huge process to it. Lots of research, lots of reading, and we share this to you to educate you. And we do this where you can see video, you can see lots of things and a lot of research engines we pay over $100,000 for. We share a lot of these stuff. We share some reports that you may not have access to, whether it's sell-side reports from Goldman Sachs or Citigroup, and show you what they're looking at. Again, that's a consensus. You want to pay attention to that. Whether you agree or not, I think they're full of shit. That's a consensus. If you could prove it wrong and their numbers are wrong, if you think they're too conservative or too aggressive, that's how you make money in the market, by going against what the consensus is. And also, access to exclusive interviews. And the most important point of it is we don't hold back on telling you the real story, no matter who we offend. It's not about that. It's about making you money. That's all we care about. We don't have an agenda, no bias. We have to answer to anybody. It's my company. So we say how it is. Again, we don't care if we offend people because we are telling the truth and we're trying to help you. That's what Wall Street Unplugged Premium is all about. If you want to learn more, go to WSUoffer.com. Again, it's just $10 a month through that link. And if you don't like it, you can cancel at any time. So guys, a lot to digest there, I know. But that's it for me. Thanks so much for listening. I'll see you Wall Street Premium members. See you guys tomorrow. Take care.